Let's mention the U.S. dollar. Another big story in today's session. It's been on a tear over the last 3 months, really, up nearly 6%. What does a strong dollar mean for trade? And what does it mean for investors, Mike, who are looking for 20% plus earnings growth? What does it do to those outlooks?
It blunts the earnings growth a little bit on a forward-looking basis, probably not in the quarter we're going to get reported, in a couple of weeks. But what it does is it represents another little incremental financial tightening, a tightening of financial conditions globally. And I do think that's why you have this kind of two-speed world where the emerging markets, at least the equity markets and currencies, are suffering, and the U.S. seems like it's kind of opening up more of a gap in terms of growth and stock market value. I don't know if it gets stretched too tight and you have to have something break there, but I think that's what the market has been on edge about, is this whole idea that you have a potential for global financial accidents when you have this dynamic in play. But right now, I don't think the dollar is screaming higher in a way that's going to make you too worried right yet.
It's not a ferocious
not yet.
reversal. That's right.
No, it's a straight shot higher, John. Do you have to adjust your portfolio with stocks, with certain exposures overseas because of the strength of the U.S. dollar?
Sarah, I don't think so. I'm kind of with Michael Santoli. I think, really when you think about an exchange rate, what you're thinking about is the interest rates that are pegging that capital flow, and beneath that, the GDP growth rates of the respective countries and economies. So what you got to think about here is the U.S. in 2017 grew 2.3%. It'll get to 2.8% this year. It's a half a tick up. And then Europe's going from basically 2.6% last year down to 2.2. Japan's going from 1.7 down to 1.1. So that's the dynamic of revenue growth in international and U.S. that's saying this is good and this is bullish U.S. And that's the subtext of the exchange story that I would put in play.
You're bringing up an important point, John, which is Europe. I don't think we've talked enough about Europe. Maybe Michael can chime in. China's getting all the headlines on trade. We export the same amount of dollar values to China as about the GDP of the state of Maryland. It's actually not that much. Europe, though, that's a real market. More than $1 trillion exported in goods and services to Europe. We've talked about auto tariffs. Is the market focusing enough on trade with Europe and currency with Europe?
Brian, we're going to find out. That's a really good point. I don't know the market's thought that through enough. I think it's focused on China and the depreciation of the renminbi much more than it has the euro. So I think the Chinese stock market, the Chinese renminbi, and those trade flows are front and center in the market's mind. But you bring up a good point. I think down the road it might figure out Europe matters a little more than they think.
Well, also its biggest trading partners are the U.S. and China. It gets caught firmly in the crosshairs, Barb. I wonder if the dollar strength is a reflection of investors around the world looking at these escalating trade tensions and saying the U.S. is the winner. It's in the relatively best shape economically to withstand all of these tariffs and these pressures.
Well, I think that's an interesting point. I see it more because actually, if we escalate, we're going to hurt ourselves as well. And I just keep thinking we won't do it, but the way it's going, we might. Now, I think it's really because our earnings are still accelerating. This quarter should be very interesting to hear what companies say, particularly looking forward. You've got the Fed committed to raising interest rates, and our 10-year yield is now very attractive vis-a-vis a lot of European currencies. So I think in the fixed income market and in stocks, and as Mike just said, our stock market is relatively undervalued, compared to others. So I think that's very attractive in itself. So I think that's more the reason capital is starting to flow here because of the strong dollar.
Yeah, I mean, even if you didn't have a lot of the trade noise, what you would have is an unusual stimulus with tax cuts and the fiscal spending, accelerating an already strong economy. You have a Fed that sees clearance to raise rates a lot more. The rest of the central banks
That's
way
all
behind.
bullish for the dollar.
That whole differential feeds to a dollar.
But is it bullish for the market? I mean, the interest rate risk is a super tanker that turns slowly. It affects everything in its wake. It's boring, but it's super important.
I know,
but all we're talking about is trade every single day when the Fed is raising rates.
Some people are talking about the year-over-year increase in bond yields, in interest rates, in what you have to pay for debt is up significantly. So that's one more restraint.
Because global debt levels have never been higher. Corporate debt and the debt held by private equity firms
I don't think it means it's game over or disaster.
It just floating rate.
It's a little bit of an offset to some of the good stuff that's going on.
And Brian, it's really about the rate of change. I mean, we are still not seeing the inflationary pressures one would expect that we've seen in every past economic cycle. We're barely at the Fed's target of 2%. And it really, it's globalization, it's online shopping, all these things keeping price in abeyance, even with oil prices going up and going to the pump. So I still, inflation will continue to creep up and the Fed will continue to creep up rates in a way that's not disruptive till much later.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.